So why repay a loan that you don't have to repay? Hello everyone, Scott Schwartz with nevertoomuchmoney.com. I reverse engineer the way that banks and the wealthy use their money so I can help my clients become virtually their own banker. So yesterday I talked in some detail about cash value life insurance, being able to withdraw money from it in the form of a loan, not a distribution, so it's tax free. And then technically you don't have to pay it back. Why? Because the insurance company is collateralizing your cash value rather than taking the money from it. You're taking it from the insurance company. They use your cash value as the collateral. So if you don't have to repay that loan, why is it best that you do so? There's two reasons. The first being, don't be unclear or naive about this. The insurance company is doing this because it's additional income for them. It's a smart business move for them. They're making additional profit. One, they are on the hook for less at the time of your death since they're collateralizing your cash value. In other words, the death benefit that they will eventually pay out will be reduced by the amount of money that you have not paid back at that time. And since there's interest tied to that, conceptually, that amount could dwindle down to nothing, depending on what the numbers are, how much you've borrowed, and for how long it has been outstanding. So it does dwindle the value of that death benefit that your heirs will receive. That's one reason. And the second reason, and this is what most of my clients are concerned about, because most of them are using this more so as a living benefit tool for their investments, starting with the first investment of buying their own debt, eliminating their debt, their consumer debt. So that second reason is it compromises your ability to accomplish that purpose. If you're going to continue using this as a vehicle for financial growth, as it's designed to be, you're going to really dilute and compromise your ability to do so by not paying back that loan. For example, you're using this to pay off debt, and maybe you do so that first time or a few times. Then you get to thinking, why bother if I don't have to do that? Well, really, that ability to continue using that as a tool to buy your own debt or use it for investment could stop completely right there or be greatly compromised. Maybe your goals have changed in that time. Maybe you've come up with an emergency that prevents you from using the money in that way. It's good to know you have that flexibility in such a circumstance. But understand that it will not be the same tool as it was intended to be from the beginning if you don't pay back that loan. Now, as I've mentioned, especially so far this week, the last 2 weeks, there's really just a 1% or oftentimes less, even zero, of a spread on the difference between the guaranteed rate of return that you're receiving and the amount of interest you owe. So we're not talking about a tremendous amount of interest like what you get from a bank. The bank, let's be honest, they have the opportunity, they have the risk, rather, is the better word, of having to default on a loan that they give. They give you a mortgage loan, there's a chance you may foreclose on that loan. So they hedge their bets by front loading that interest through amortization, even though they lie about it, in order to reduce their risk. With the insurance company, there is no risk. They know you will die at some point, and they've got that cash value to collateralize the indebtedness. They're not worried about that. They will make that money back. There is no risk on that part. so they don't have to do tricks like amortization or the front loading of interest. It's simple interest that just barely exceeds the amount of return that you get through guarantees and dividend payments. So there, there really is no downside to paying back that loan. That money is growing, usually at just barely under that interest rate, or depending on how the dividends pay that year, it could be even a profit. There could be arbitrage on that loan itself. And that's something that we'll talk more about in the future. But I wanted to bring this information to you so that you understood this is intended as a loan with the payback assumed. And while it is an option that you don't pay it back, generally it is best that you decide to stick with the plan and do so, so it continues to be a useful financial vehicle for you. Thank you very much, everyone. Have a great day.